Hello everyone, I'm Kunal Sodhani from Global Trading Center. Once again here for another episode of understanding the global dynamics, domestic factors, and there are so many things exciting, when it comes to volatility in the market, both on equities, debt, as well as on the currency pairs. But yes, let's stick to the currency pairs for this moment and let's understand what exactly is happening around. So first talking about the domestic factors, and if we talk about the flows have been probably flat for the month of February for equities, but we have seen a decent inflows of around 22,500 in the debt segment. Also, if we talk about March, we have seen an inflow of around 6,100 crores in equities and a flattish approach for debt around 2,000 crores of inflows in the debt segment. So net positive as of now in the month of March, or probably flattish at this point in time. But if we see the indices, they have been near the all-time highs and even touching the highs as well. If we talk about the flows in terms of the maturing swap by RBI, which is on 11th of March, we see a lot of things to understand from that perspective because if you see the cash term cash pot levels, they have been moving lower, which in turn means the forward premiums are also moving lower, which the market is concerned. Reason definitely remains there is dollar crunch already into the market, and if this swap, because of this swap, there can be only two scenarios: either the RBI may roll over this or possibly may take delivery of this maturity, which is a $5 billion, which if in case if they take the delivery, that's what our assumption is, because in order to ease this liquidity conditions, the tightness of conditions of liquidity, they may take the delivery of it, which in turn will release almost around 50,000 crores of INR fund into the market. So that is why when banks are considering this point in time that this delivery is going to happen on 11th, people or banks are receiving starting from the last week itself, due to which the forward premiums and the overnight levels have dropped. This is one consideration to watch out from the domestic perspective. But if we talk about the global factors, this week was probably ruled by the jobs data or the labor data. So it started with the US JOLTS opening data, which came in weaker than expected. Then came the ADP employment change. That is also the important data point considered from the US perspective, but that also came weaker than expected. A couple of data with respect to labor are more, expected. That is unemployment claims, non-farm payrolls, even average hourly wages. So these three data are still anticipated today and tomorrow, which will be a decider again, what the trajectory of how the Fed will go about on the interest rate part. But considering these two data which are already out, they were weaker than expected, and thus dollar index, moved from 104 to 103.20 levels, which means the dollar took beating against the majors. Euro dollar bounced above 1.09 levels, where GBP bounced above 1.27, and dollar yen moved below 149 levels, 149 levels. So if we take those into cues, what are expectations? First, if we talk about dollar index, it's having a resistance zone at 104.85 levels, as we discussed even in last episode, that it has bounced almost 7 times to those levels, but it has obviously reversed every time from those levels. That's one important consideration. Second, we have the ECB policy where we don't expect any kind of rate change until there's probably Fed starts beginning with. And considering the Fed officials and even the testimony of Powell, we don't see that it is gonna come anytime soon. They are being quite cautious, vigilant when it comes to inflation. They are open for rate cuts, which may happen, but taking into considering the incoming data. So they are giving that importance even now, the month of June. It may start from the month of June. But again, as I said, it's still a discussion, and the Fed speakers are also a bit hawkish on that front. So it may not be a surprise that in the entire year till December 2024, we see only two rate cuts from Fed and possibly one by RBI. That too may depend on the monsoon conditions as well. So that's from the hawkish perspective, due to which dollar index may remain subdued for some more time. Yields also took a beating. It went sub 410 levels, that is US Treasury yields. Brent crude price is still, on the right side, bouncing and waiting at around $82, $83 per barrel. And the geopolitical issues still continue, though it remains silent in terms of news feeds, but that's an important factor to watch out. For dollar rupee, we are surprised to see levels now finally moving below 80 to 80 levels, where it was such a long consolidation between 80 to 85 and 83 big figure. The view from here in terms of our technicals, remains 82 half and 83, this to be a broader range play. Considering March end, we expect more inflows to be a part of the economy, where we feel that there is an appreciation bias on the rupee, though lower levels may be bought. But I think broadly still the range 82 half to 83 may remain for some more time. For exporters, we will just recommend that because the premiums are lower and the spot is moving also lower, it is hitting them from both angles. So anywhere if we are able to find levels on the top side 80 to 90 plus or near 83, it's good levels to please hedge your exposure to some extent. While for importers, we can keep a stop of big figure 83 and have a staggered manner hedging between 83 half and 82 half and 82 80 zone. So for trading mentality, receiving interest still continues to remain, and let's see how the swap conditions move after 11th of March. Maybe some kind of paying may seen after that, but let's see. From trading perspective, probably crosses remains a better play. Playing from the long side on non-dollar currency pairs may remain preferable. So that's all from my side, friends. Thank you so much all, and wish you all a very good week ahead. Thank you.